What if I told you the biggest investing mistake isn't picking the wrong stock? It's relying on just one ETF. Millions of Americans believe buying an S&P 500 ETF is all they need for retirement. And while it's one of the most popular investments in history, there's a hidden weakness that almost nobody talks about. If the largest companies slow down or one sector crashes, your entire portfolio can take a hit. So, what do experienced long-term investors do differently? They don't abandon the S&P 500. They build something much stronger around it. Stay until the end because I'm going to show you the 5 ETF fortress portfolio that could make your investments more diversified, more resilient, and better prepared for the future. The first ETF is the S&P 500 ETF, and it's the foundation because it gives you ownership in 500 of America's biggest companies, like Apple, Microsoft, Amazon, and Nvidia. But here's the catch. It's heavily weighted toward a handful of giant companies, meaning your portfolio depends more on them than you might realize. That's why the second ETF is a total U.S. stock market ETF, which adds thousands of small and mid-sized companies that the S&P 500 doesn't include. These businesses may be tomorrow's biggest winners, giving your portfolio more growth potential. The third piece is an international stock ETF, which invests in companies across Europe, Japan, Canada, Australia, and other global markets. If the US economy slows while other regions grow, you still have opportunities to benefit. Next comes a bond ETF, and this is your portfolio's shock absorber. When the stock market becomes volatile, bonds have historically helped reduce overall swings, making it easier to stay invested instead of panic selling. Finally, there's a Dividend ETF, which focuses on financially strong companies with a long history of paying reliable dividends. That means you can potentially earn passive income while continuing to grow your wealth over time. Together, these 5 ETFs don't try to predict the future. They prepare for it. Instead of betting everything on one part of the market, you're spreading your investments across different company sizes, countries, and asset types. That's why many long-term investors call it a fortress portfolio, because when one wall gets weak, the others help keep the entire structure standing. Now, I want to ask you something. If you had to invest your money in only one ETF for the next 20 years, which one would you choose? Drop your answer in the comments before you hear what most experienced investors recommend. The smartest investors don't build wealth by chasing the hottest stock every year. They build portfolios that can survive almost any market. If this video helped you think differently about investing, hit like, subscribe, and turn on notifications for more simple, evidence-based investing strategies. And remember, the goal isn't to own the most ETFs, it's to own the right combination of ETFs and stay invested for the long run. Thanks for watching, and I'll see you in the next video.